I don't want to let everyone off the hook here, but I do think to an extent, a lot of the FTX rounds were a byproduct of the funding environment from last year, which were extremely low interest rates, tons of capital flooding into the VC market, a lot of crossover funds dipping their toes into venture. And naturally, when you have so many more bidders than opportunities, that moves price up, that shortens diligence time, that shortens the amount of negotiation and leverage that VCs have in those conversations. And so, it's easy to look back and say, oh, there should have been a board. There should have been more oversight. But the VCs who were asking for those weren't getting into the round. And that's sort of where the rounds ended up getting cleared. I think there's certainly a lot of fishiness around the wall between FTX and Alameda, and again, the overall corporate structure. But it's not obvious to me that, in the last funding round, there were already shenanigans being played with consumer funds, or that Alameda was already insolvent, or a lot of the financial issues that we're now sort of uncovering. So at the time of diligence, things may have looked fine, but it's these broader issues, as you sort of been pointing out, around oversight, around compliance, around auditing, all those kinds of things.